final, you may not use your DCF analysis much at all. You may choose to use the comparables model. And so a lot of the detail that will be in this early version of the DCF may be less important in the final version. Your assumptions still need to be in there. But you may write up a material right now about what your competitors are doing, and that's driving your growth rates. And then later on, you choose to use the comparable method, and you're using a multiple as opposed to the DCF. So some of your competitor data may not be quite as relevant. But including it, if you have it now, including it now makes sense. But I'm not looking for pages and pages on each company. I'm looking for the assumptions on each company.
Okay.
Okay.
You're looking for the assumptions for both for the midterm and the final. But for the final, you are expecting a little bit more description about the market and the competitors and that stuff, correct?
And for the final, I also want you to tell me what your recommendation is and why. So for each company. So that's a little bit more detailed. I'm not really expecting you to go into much detail on this one. I want to see your model, but I'm not for what's due on the 22nd, but I'm not concerned about the detail about what your recommendation is yet, because we're only halfway through the material. So your recommendation may shift. So there's no reason to spend a lot of time on it at this point.
Okay.
Any other questions about the project?
This is Stephanie. I have another question.
Okay.
When we talked about like how to lay out the groundwork for the DCF, we talked about projecting pro formas for the income statement, and I think for the balance sheet, and obviously for the DCF for about 3 to 5 years projection.
Yep. Okay.
And then I think during the last lecture, you talked about calculations of net operating working capital and using that as a % of sales. I'm trying to think of how that looks in terms of a projection for a balance sheet.
Okay, so for your balance sheet, what you're going to do is you're going to look at your working capital accounts and your capital assets as a percentage of sales. Because if you think about what causes them to vary, when we do a common size balance sheet, we do everything as a percentage of assets. But the reality is, for a company particularly that's growing, their working capital accounts and their assets grow as a percentage of sales more frequently. Now,
Right.
You may have a company where that doesn't hold true, that it is that capital assets are a constant percentage of total assets. That's why I want you to do the common size statements forward, or I'm sorry, do the common size statements looking back. But when you're moving forward, in all likelihood, your net working capital needs and your capital assets are going to be a percentage of revenue. So when you do your pro formas, that's ordinarily how you create your balance sheet, based on the percentage of revenues going forward. And the plug figure typically is your debt number. So do your income statement, which will give you net income. You'll know how much is retained, how much is paid in dividends. If your company pays dividends, that will change your common equity account. You're going to do your working capital and your capital assets as a percentage of revenue. And then to make your assets balance out to your liabilities and equity, you're going to plug in your debt figure based on requiring it to be balanced at the end of the day. Does that make sense?
Yeah, I just, I thought that you said that we would do like a net working capital number as a % of sales, but really we have to look at each line item as a % of sales, right? In order to do the pro forma.
Yeah, in order to do the pro forma, you do, in order to get your debt number, because you need to know current assets and you need to have the total asset number. So you need to split out your current assets and your capital assets to get your total assets in order to get your debt number that needs to balance. But when you're projecting, I see your point. I see why that's confusing. I don't really care what the percentage is. Oh, let's see. Let me think about that now. Hold on, let me think. Oh, no, you can get there. So your net working capital and your current assets, and then subtract out. Yeah, you can do it. So if you just do your net working capital and your current assets, subtract out your equity, what's left is your debt. So it'll balance out okay. So you don't.
Okay, so for the pro formas, we don't need to go into balance sheet line items.
I don't care what your accounts receivable is and your accounts payable and your notes payable and things. I don't care about those numbers specifically.
Got
it. I care that your balance sheet balances at the end of the day.
Okay, that helps.
And I care about what your net operating working capital looks like as a percentage going forward in pro forma. So I know what the investment is in working capital over time. I know the
Right.
capital assets over time.
Okay.
What your accounts receivable number is and your accounts payable, that's almost impossible to forecast. They change. I mean, those short-term accounts change so rapidly. So it doesn't matter specifically what those numbers are on a year-over-year basis.
Okay. And
Okay.
so how would we treat cash for projecting the balance sheet pro forma?
You're going to have to make an assumption there. If you
Okay.
believe the company has the right amount of cash now, you can presume that it's a percentage of sales if you want. You can presume that it's a steady state. You can look at competitors and see what their cash is relative to sales typically. And if theirs looks stable over time, you can make that sort of the goal. So if you're currently at 10% cash and the industry norm is 3%, you could have, your assumption could be cash will decline down to 3% over the course of the next 5 years. So have it steadily decline. It's not going to go from 10% to 3% right away, but presume it's going to be sort of a smoothing process to get it down to the 3%.
Okay.
Now,
That helps.
if you believe your company is going to replicate the industry norm, if they're a market leader and they're holding cash because they're trying to be available for acquisitions, it's okay to still presume that they're going to hold more cash than usual. That's an assumption that you're making. If they are a real if they're Sears and they're a real laggard, you're going to throw out a whole lot of what the industry is doing because the industry is not terribly relevant to Sears at this point in time. So your company is going to drive a lot of those. That's why I want you to turn it in now, so I have a chance to look at your assumptions and get a sense for whether or not you're on the right track before you turn in a final project that actually gets graded.
Okay, thank you.
Any other questions about what to do next week? Okay, let's take a look at chapter 4. Most of you are going to find this pretty easy. There's a lot of chapter 4 is a rehash of how to do a weighted average cost of capital. Where we run into challenges is when the company has a changing capital structure or some circumstances are changing. It's also challenging if we're in a recession or a changing economic environment. The beauty is, since we've been in growth mode for the last 10 years, looking back won't be too terribly difficult if you presume that the future is going to be similar to the historic data that you pull, whether you're pulling 3 years or 5 years or 10 years. But we're going to get started with cost of capital. The formula you should be familiar with. The weighted average cost of capital is equal to your cost of debt times 1 minus the tax rate times the percentage of debt that you use, plus your cost of preferred if your company uses preferred, plus the market weight of preferred, and then your cost of equity times the percentage of equity that you use. Same thing that we did in 703 in the past. Now, the things to keep in mind, we want, when we're estimating our capital structure, we have to come up with these weights, and they're market weights as opposed to book weights. We want to look at the opportunity costs. So we want to pay attention to what the next dollar would be used at for this money. So we want to be more forward-looking than backward-looking. We'll get to that a little bit more depth in a few minutes. And then we take those weights that we figure, these costs that we figure, and then we complete the calculation to come up with an overall weighted average cost of capital. As you know, it's available on Bloomberg, and for many of you, that will be sufficient, but for some of you it won't, and we'll see why later. The other thing that's important in this chapter is you know that later in the semester you're going to be valuing Rosetta. Rosetta is privately held, so there's going to be nothing on Bloomberg about them. They're way too small. You're not going to find much of anything publicly available. So some of these techniques you'll be using in your teams when you are looking at valuing a privately held company. And next week we're going to have Linda Bartlett's going to come speak, and she was a partner at one of the accounting firms, and then she was CFO at Marriott, and then she was CFO at Intelsat, where she took them public, and then now she's currently CFO at Pew Foundation, and so she's had a variety of experiences, a lot of experience with valuation. You'll have a chance to talk with her and ask her some questions about both the IPO process, especially for you guys that are doing the startups or the really high growth companies. She'll have some good information relevant to your projects, particularly. All right, so we want to use market weights. Now, the one caveat here is for debt, we frequently use book weight. and market weights don't vary much on debt because there's not much trading that goes on. So frequently we use book weights for debt, but for equity, certainly. And even for preferred, we're looking for market weights, and those are relatively easy to find. We want our costs to reflect our required rate of return going forward because we're valuing our company as a going concern. Now, we typically do that by looking at data that looks back, but there's always the ability to make some adjustments if you think the future for the company looks very different than what you've seen historically. Again, it's an assumption. Now, sometimes we have companies that are changing their capital structure. Now, if your company recently acquired another firm or went through some kind of acquisition where they've ramped up their debt, so when you're looking at their common size financial statements, if their debt levels have changed over time and they vary a great deal from what the industry standard is, oftentimes a company, especially a company in growth mode, will adjust their capital structure. Well, one of the assumptions in weighted average cost of capital is the percentage of debt we're using and the percentage of equity. If those rates are going to change through time, we have to do what we call an APV model. We have to do an adjusted present value model where we're going to allow those weights and consequently the weighted average cost of capital to vary through time. So that's one of the things I want you to keep in mind as we move forward. Something else I was going to say about this. The other thing to keep in mind. Now, remember what we did last week? We talked about the operating leases. When we recognize operating lease as debt, the percentage of debt financing has changed. So if you have the Bloomberg data and you're using Bloomberg, and your company has operating leases, the weighted average cost of capital in Bloomberg will not be sufficient. It's a minor calculation adjustment you're going to need to make. But if your market value of debt it was 30%, and now that you have operating leases, it's 45%, you need to make that adjustment. It's a small calculation because if you're 45% debt and you have no preferred stock, you're 55% equity now. So your overall cost of capital should decline. 45% debt times that lower cost of debt times 1 minus tax, plus now 55% equity times the cost of equity. But the Bloomberg weighted average cost of capital, if your company has substantive operating leases, Bloomberg is not sufficient. You're going to need to make that adjustment based on the shifts of the market weights. Does anybody have questions about that or anything there unclear? That's a change. Stephanie?
Yeah, I have a question. Looking at like the current year balance sheets for companies that have a lot of operating leases, if we're trying to do a trailing 12-month view, well, we have a mix because the operating lease treatment has changed in 2019.
Hold on, you cut out.
With the accounting standard changes, operating leases are now going to be recognized as debt on balance sheets, I think starting in 2019. So.
And when did your company close?
Their fiscal.
Okay, so you've got 3/4 of that. Okay, so if you've got the operating lease data in your 2019 financial statement, then only add the operating leases back to the Q4 of last year. Let me think. Look at your operating leases over the last 3 quarters of this year, presuming you've got Q3 data, or at least the first 2 quarters of this year, and look and see if you can figure out that they are constant or are growing at a small percentage or are a percentage of your revenues, typically revenues. Yeah, look and see if there's some constant percentage, and you can figure out a way that you can project the Q4 of last year and potentially third and Q4 of last year. Yeah, I forgot with the tax treatment, you're going to need to make a little bit of a shift there.
Okay.
I still think, what's your company, Stephanie?
Chipotle.
Yeah, you've had enough upheaval in the last couple of years that I think you're going to be better off doing the trailing 12 months as opposed to just pulling 2018. I think you're going to be happier with the results. You know, they're in the news constantly. They were in again yesterday. They're doing well all of a sudden, after the salmonella and the decline for a while. And they've had leadership changes when they were part of McDonald's and now they're not. So I think you're going to want to look at the trailing 12 months on those guys.
Okay.
Okay. Yeah, you could take, let's see, so you at least have 2 quarters of leases.
Is the trailing 12-month view that comes out of Capital IQ reliable, or do we need to create our own?
Capital IQ has, they call it LTM, last 12 months. So that should be
Yeah.
reliable.
Okay,
Why do you think it's not?
I don't know. I just, because you mentioned in the last lecture that we should calculate it, so I thought maybe it wasn't treated correctly. And
That's because I didn't realize at the time.
oh, okay.
So I had looked in Bloomberg and couldn't find it. And Eric came over and he uses Bloomberg a lot. So we went looking and talked to Bloomberg, and they say, yeah, no, we don't calculate that. And then I pulled up Capital IQ and thought, and made an adjustment, and it's right in there. So yeah, I would absolutely take it right out of Capital IQ.
Perfect.
Yeah, no, it's perfectly good. Thanks. I forgot you weren't there. Yeah, it's perfectly reliable. I mean, we probably weren't recording at that point. It's perfectly reliable. It's just at the moment I was looking in Bloomberg and I wasn't thinking about Capital IQ.
Okay, great. Thank you.
Okay. So we typically, when we're doing capital structure, we want to look at market values for the market value weights for our debt, preferred stock, and equity. And we're going to market value weight our cost of debt, our cost of preferred, and our cost of common equity. The only thing you need to remember with debt is that it's an after tax. So you find the cost of debt and multiply it by 1 minus the tax rate. Now we're going to go through each of the 3 kinds of costs that we need to come up with. Debt for publicly traded companies, we want the yield to maturity. That's available. It's on Bloomberg for publicly traded companies. Now, there's a couple of circumstances where you may run into trouble. If the company is not publicly traded, then you want to look at similar firms and figure out what their cost of debt is, and then make adjustments for your company's. If your company has a different credit rating, then you're going to make a bit of an adjustment. I'll show you how to do that in a second. So that's one adjustment to make. So if they're not publicly traded, or for any reason you question the debt data that you're getting, look at comparable firms and see what their debt is, and then use an average of the comparable firms and then adjust it based on the credit rating for your company. And we'll see that in just a second. The other time you need to make an adjustment is if the company has a likelihood of being in default. Corey, I hate to call you out a lot, but yeah, you're on this one too. Anybody else that where you think your company, pennies maybe, where you think your company may not be around in during your projection period, so 5 to 10 years, that you think they may no longer be here. You've got to think about this process. And what you're going to look at is you want to look at the probability of default, and then if they go into default, what's the recovery rate? And how likely are you to recover anything on your investment? So the formula shifts a little bit, and it's a minor shift. So for most of us, what we're going to do is we're going to find our yield to maturity by looking at where the price of the bond is right now, look at the interest payments, look at the future value, and compute your yield to maturity. For those of you that have a company that might be in default, it's a similar process, except you take the present value of your interest plus principal and multiply it by 1 minus the probability of default, and then take that present value of your interest plus principal and multiply it by the probability of default times the expected recovery. So what percent can you expect to recover if indeed your company goes into default? Now let's do a quick.
And by the percent you expect to recover, what exactly does that mean? Like, how do you? What's the best way to estimate that?
I would Google and look and see what they're showing for companies such as Sears, what the recovery rate is. You know, you can see estimates anywhere from under 10% to 50%. Typically, equity holders aren't going to recover all that much, but in Sears' case, they're a little bit different because they have all these physical assets that they're continuing to sell. I think I just saw they're selling another 100 stores. So, so they have some physical assets, which increases the likelihood that the equity holders get something, and that probability, they are already in the process of going through default. So there should be some data about the percentage of not only the probability of default, but the percentage that you can expect to recover as an equity holder. And Corey, if you look and you can't find anything, let me know and I'll go take a look too.
Okay, so this is an adjustment to the cost of debt, but it's the recovery rate of the equity.
That's no, it's the it's the recovery rate of your debt. Sorry, it's the probability of recovery, the probability of default times recovery. Just the recovery rate of your debt. Yeah, it's what percentage the debt holders are going to get back. Sorry, but
Okay, so not the equity holders.
No, because
Okay.
equity holders won't get much.
Okay.
Okay, and I don't want to make it overly complex because Sears is a tough company. When you look at a number of their bond issues will probably be secured, so their probability of recovery is going to be greater. So you may need to look at their debt issues in chunks. So the ones that are secured and what their probability is of recovery, and then the ones that are unsecured. And you don't need to go through issue by issue. I'm assuming there's probably at least 20 plus issues, but I would clump them based on whether or not the debt's secured or not. Okay, so where do we get this data? Well, Capital IQ, of course, and then Bloomberg has your debt data. Morningstar, I know you used Morningstar a lot when you were in Professor DeSouza's class. Now, you can also, especially for a company like Rosetta, you can look at their credit rating and then look at the yield chart to get a sense for what the cost of debt might be. And then the 10Ks typically have all bond issues for a company listed. That's the most complex way because you got to calculate a yield on each one of the bond issues, and then you have to weight them based on the size of each bond issue. So if you can find publicly available information on the debt, that's going to be a little bit easier. And whereas we say we use market value weights, the reality is for debt, the book and market's not much different. So it's fine to use the book value of debt to come up with your market rates. I just threw this in, so you've got the chart of what the different bond ratings are, and then there are tables that will tell you what the likelihood is of default for each of these ratings, and so that'll give you a sense if your company is rated BA1. It will give you a sense for what the percentage is that they will still be around 5 years from now. All right, I want you to take a minute. I'll go ahead and put you in breakout rooms. You really don't need help in a breakout room. But if you would go ahead and write or copy this problem quickly. I open the rooms. So just do a quick calculation of the pre-tax cost of debt on this, just to remind you. You can either use calculator or Excel, whichever you prefer. And come on back in when you're done with the problem. Curtis, did you guys have enough time?
Did you say Curtis or Chris?
I said Curtis.
We didn't get to the second one, but we did get to the first.
Okay. Everybody's back, I guess. Did anybody have a chance to finish both parts A and B?
No.
We
Yeah.
did. This is Stephanie.
Okay, Stephanie, why don't you go ahead and talk about it?
Okay. Do you want me to just go through the answers and how I got them?
Yes.
Okay. So for Eastman, Celanese, and Dow, working from top to bottom for unlevered betas, I came up with 144, 166, and 146. Is that right?
That's right.
Okay. And what I did was I took the given levered betas, added those to the the debt beta times the ratio of debt to equity, and then divided that by 1 plus the debt to equity ratio
Okay,
for the formula.
good.
What you might have covered this already, but the debt to equity value, is that just the like book value of debt divided by book value of equity?
It is, yeah, yeah.
Okay. And then the second part, I just applied the formula to come up with the levered beta using the 0.2 that was given in the problem.
Okay. What are you comparing it to?
So I came up with the average of unlevered beta for the first 3.
Okay.
And multiplied that by the 1 plus the ratio minus the 0.3 times the ratio.
Okay, good. So, and what did you get for that?
176.
Yep. Excellent. You guys wrote fast. Okay, so the formula that was on the previous page, we come up with an unlevered beta. Oh, it's not even, let me color here. We come up with an unlevered beta for each of the 3 firms. It's 1.44, 1.66, and 1.46. We average those together to get to an industry average of 1.51. And then we take that number, and using this formula, we relever it for our firm, for Sterling, to come up with a relevered beta of 1.76. I was lazy.
Are you sharing your screen currently? I'm not able to see anything.
Oh, you're not. Oh, you can't see it. Ah, that's a problem. Let's see.
No, there it is.
It's back? Okay, let me see if you're going to be able to see this page. Thank you. I didn't realize you couldn't see it. Pull it back up. Sorry, I'm getting to it. Thank you. I didn't realize it wasn't showing here. Can you see that now? Yeah. Okay.
Yep.
I didn't feel like rewriting all of the formulas because it just takes so long to incorporate a formula. So I just uploaded my chicken scratch here. So we have, here is for Sterling. It's the previous one. There we go. Okay, so here's the first page where we have the betas for each of the 3 firms, Eastman, Celanese, and Dow. And then, as Stephanie said, she took the average of those 3 to come up with an average of 1.52. And then you take that number and apply it in this formula to get Sterling's based on their debt to equity ratio of 0.2 and the beta for debt. I've never seen anything used besides a 0.3, so just presume that's a given. And we come up with the equity beta for Sterling of 1.76. We use this a lot because there's a lot of privately held companies or a lot of firms that are in flux. And so we sort of look at the expectations in industries. Most industries do have pretty stable debt to equity ratios over time. So looking at the average across several firms will give you a decent estimate of what the expectations are for your company going forward. Any questions on this problem?
No. Do you mind going back 1 slide so I can grab that? Yeah, there we go. Thank you.
Sure. Pretty good?
Yes.
Okay, so what are you going to use for beta? If you have a standard vanilla kind of company that they've been around for a while, their capital structure is pretty stable, and you're not expecting any big shifts in their industry. You know, if you're Time Warner acquiring AOL, that's a big shift. So the historic beta might not work, but in general, standard companies that are doing well, that have been in business for a while, you can use historic company betas. For companies that are experiencing flux, so they're going through Chapter 11, something has changed pretty dramatically in their companies, the method we just used, unlevering the industry betas and then relevering based on your company's capital structure, is a better approach. And then companies that you're thinking maybe changing their business mix, or if they're changing their capital structure over time, you can forecast the beta forward. say, okay, so today our beta is 1.4, but I'm presuming based on the fact that we're going to have continue to grow over the next 5 years, that our beta is going to decline closer to where the industry average is. And you do that assumption without levering and unlevering, because your company's capital structure may not be where it's going to be in the future. And so they're too heavy debt right now, or they just went public and so they've got a lot of equity and not much debt. But that's not standard for the industry. So over time, you're expecting their debt levels to rise, which will cause their cost of capital to come down. So you can forecast forward. You do not need to run a regression. You don't have data to forecast it forward, but you're making some assumptions on where the company's beta is going to be through time. So in general, those are the 3 different approaches to coming up with a company's beta. The most common by far is using historic company data. But that requires a lot of stability. We even question using historic company data when you suddenly hit a recession and you've been having some challenging times. 2008 through about 2011, using historic data became problematic because it wasn't representative of what the expectation was going forward when you have that deep of a recession. Okay. Then you have to think about, well, if you're calculating a beta, how far back do you go? And it depends. It depends on whether you're using daily, weekly, or monthly rates, returns. What is most common now is probably using weekly returns over a 5-year period. The book says you can go 2 years to 5 years. If you have a company that's experiencing a lot of change, and yet you think the history is relevant, then you can go back just 2 years. But if you're using weekly returns, and daily returns have so much noise in there that it's more common to use weekly returns. So weekly returns going back 5 years gives you a nice size data set. But I would tell you that if you've got a company that is high growth right now, that shortening the period isn't going to solve your problem, because what they look like historically is not going to be what they're going to look like in the next 5 to 10 years. So I think you're better off forecasting going forward. It's another area where I disagree with what the book has to say. Okay, so what do we have? So which beta are we going to use? They say use 2 years if it's dynamic, 5 years for most. I would say use 5 years, and if it's dynamic, to look forward as opposed to back. And then for privately held companies, you're typically going to do the unlevering process using industry standards. Now, the risk premium. It used to be so simple. If you think about endowments, endowments used to be able to assume they could spend 5% of their endowed value because the market was always going to grow by about 7%. And so spending 5% was a conservative estimate, and the endowment would continue to grow. Well, that completely got upended in 2008, and it has not recovered. So it used to be we expected the market premium above the risk-free rate was about 7%. And that was when we had a risk-free rate. So, the risk-free rate was around 4 to 5%, and the market premium, usually the return on large cap stocks, we were expecting to be about 12%. Well, then we started messing with interest rates, and they're close to 0 now. And as a result of all of the systematic trading that's done now, the risk premiums have shrunk. And so the premium is now closer to 4%. The book says to use 5%. 5% I think is dated information. I would use 4% as your market premium. It's just much more realistic. Here's the Duff and Phelps chart. It used to be called Ibbotson. You may have been, Duff and Phelps bought it from Ibbotson a few years ago. That if you looked historically at large company stocks, you could expect a geometric average about 9.8%, arithmetic as 11.8%. Those numbers have definitely shrunk. You can see this is only through 2012. And so that data is a little bit dated. I don't buy Duff and Phelps every year, but I bought it a couple of years ago. So if you want to look at a Duff and Phelps, I've got probably a 2015 is my guess. But this gives you a sense in general for owning stocks, what you should expect to to earn over time. Now look at the data. So this is good data, presuming you're going to go back to 1926 on what you would expect to earn. So that's pretty dated. Usually what we assume is you look through at least one full economic cycle. So for us, that would be looking back at least 10 or 15 years to figure out what you would expect what you expect returns to be on average. And you can see here the standard deviations give you a sense for how risky the investments are. The higher the expected returns, the higher the risk. Okay. So now CAPM, the real issue with CAPM is it just doesn't work very well. Despite the fact it doesn't work very well, it's what everybody uses. You know, we had a big push on a few years ago about switching over to Fama French, and Fama French was great until the recession, and it fell apart. The R-squareds really dropped, and so it was, again, an indication that, you know, it's not based on theory, it was based on what was working. Well, we hit a recession and it stopped working. So most companies hadn't really adopted a factor model like Fama French. They kind of stuck with CAPM, and they have continued to do so. What some companies are doing, because the interest rates are such a historic low, and therefore stock returns, the market premium is so low, what some companies have begun to do is adding what we call a size premium. And smaller companies tend to be riskier, so we'll calculate a beta and add a size premium to it in order to up the beta or the riskiness of the company's stock. And here's an example using Cheesecake Factory. So it's a mid-cap size company based on this page. It says mid-caps are from 7.6 billion to 1.9 billion. So in that range, we tend to consider that a mid-cap. And if so, then we would add 1.12% as a premium. And so when we calculate the cost of equity for Cheesecake Factory, we're using a 10-year T-bond rate, 10-year treasury, and it has a rate of 2.24%. The beta is 0.63 for Cheesecake Factory. The equity risk premium they're assuming is 5%. Nowadays, it's probably better to assume 4%, but in 2015, that's what they were assuming. And they're adding this mid-cap premium. So they just are using CAPM plus that premium. So they've got the risk-free rate of 2.24 plus beta, plus beta times the market risk premium plus that size premium to come up with a cost of equity of 6.51%. And a lot of the reason we've started adding these size premiums is just because the cost of equity are looking too low based on historic numbers. So the size premium is a method to get it elevated a little bit, to make it a little bit more realistic looking. All right, in addition to adding a size premium, the other thing you can do is you can use Fama French. And if you recall Fama French, it says, yeah, the market premium is important, but there's other things. When Fama and French, who are University of Chicago economists, finance professors, what they recognized is when they looked back historically, they did what we call data mining. They looked to find what factors worked and made sense with the market. They said that small company stocks tend to earn more. And we saw that earlier. They're riskier, and so the expected return for small company stocks is higher. But what Fama French observed was, yes, they earn a higher return, but they earn even more than what they should have. So there's an additional size premium that we need to account for. They also looked at market-to-book stocks, and they noticed that value stocks earn less than growth stocks, but they earn more than they should as value stocks. So there's a little premium that value stocks are earning. Now, we can really argue that this probably is not holding up at all right now because value stocks are way underperforming. But when Fama French came up with this in the 90s, and really up until the recession, people were starting to explore the idea of substituting this model instead. If you remember from most of you in my class, we did a weighted average cost of capital project, and you used Damodaran data. Damodaran is still tracking information, so a lot of these variables you can pull right from Damodaran data. And here we look at a model where we're taking Apple, and we have the coefficients for Apple that they pulled from Damodaran's data, and the Fama, using those, they come up with the Fama French cost of equity of 5.98% based on this beta. They have a CAPM cost of equity of 7.1, and they're showing you what the difference is. you're going to get different numbers if you use Fama French versus CAPM. And your argument can be that I want to be careful about my projects, and I want to make sure that we're absolutely creating a project that's creating value. So I'm going to use a higher cost of equity, or I think the market I think that the riskiness of our company is going to be lessened as time goes on, and so I'm going to use the Fama French cost of equity. You just have to justify which one you're using. I would tell you today that most common is to use CAPM or CAPM with a small size premium added in. Okay, so historic returns may not necessarily predict the future as conditions continue to change. The other challenge you have is when you look at the market historically, you've got what we call survivorship bias, because the companies like the Sears of the world that are delisted and are no longer publicly traded, often they're not very good performers. And so those companies are removed from the market, so you're getting a slightly exaggerated return on the market because you are not including those poor performers who were delisted. So with equity, you have to decide if you're going to adjust for size or the value factor, the market to book factor. And you also have to decide if CAPM is going to be a good estimator for you in coming up with the cost of equity. Oops, here's a problem I want you to do. And it is, you know what, oh, let's take a break. Sorry, we went long. Let's take a break. And then when you come back, I'll open up your rooms and we're going to do problem, I don't remember, I think it's problem 12, I believe. Let me just make sure. Yeah, you're going to do problem 12. So come on back at 8 o'clock, and when you do, you go ahead and pop into your rooms and work on problem 12, and then we'll reconvene.
Not quite.
Okay. Before we do this problem, I wanted to show you if you're going to need to use industry comparisons to calculate a beta. In Capital IQ on Excel, they do it for you. So they'll identify a series of companies that are your competitors, and they'll unlever the beta, and they come back and they even tell you your company's levered beta based on these firms unlevered and relevering. So in this case, this is 3M, and they picked 3 comparable firms for them. They unlevered the beta. They came up with an average, and they took that average to relever it and calculate a levered beta for 3M. So to get here, it is, I gotta move this stuff out of the way. Here we go. Okay, so when you're in Excel, click on Capital IQ, come over here to templates, go all the way down to the bottom where it says valuation, and inside valuation there's WACC. And if you put in a different company's ticker, let's see, we're in New York Stock Exchange, so let's put in, I hate IBM, P&G.
Why don't you just put in Sprint?
Because that's just too easy. Tesla, gosh, I'm having trouble even coming up with a good company. Let's put in GE. It'll be interesting to see who they're using to calculate their industry comparisons. They're a tough one for industry comparison. Okay, some similar firms here. So they have Honeywell and United Technologies, and then when they ran it, they came up with an unlevered beta, an average unlevered beta, and then they relevered it up for GE right here. So you don't have to do the calculations. I want you to understand how to do the calculations, but Capital IQ does it for you. Any questions on where I got that data or how to go about grabbing that if you're going to need it?
Is our company's WACC calculated in Capital IQ as well, in addition to Bloomberg?
Well, partially. So the challenge with WACC in here, it tells you what you need to do. Let me turn this thing off. See, if you come over, my screen looks very different than yours. There's all kind of junk open up when I'm in Zoom here. So it comes over here, Stephanie, and it will tell you all these, how to come up with the cost of capital, and it will do the calculations, but anything in red you have to add in. So the red numbers are where your assumptions come in. So your tax rate, it's saying 43.4. That's probably based on something related to GE, but it may not be what the marginal tax rate is. And they're using a market return for the last 10 years of 11.3. That seems high, but that's what they're using. They're putting no size premium, which makes sense for GE. The cost of debt, they left blank. So you need to fill in some of these values, and then you're going to get a calculation in Capital IQ. But anything in red is just a placeholder, and you need to replace something there.
I don't think we're seeing that same screen. At least I'm not.
Oh, let's see. Yeah, I see what you're seeing, and you're not seeing it. Okay, well, I can't get it to move there. Mine shows it, but on my laptop, which shows what you guys see, it doesn't. Let me see if I can shrink it and maybe make it show up that way. Let's see. Yeah, I'm sorry, I can't get Zoom to zoom all the way over there. It's blocking. But where these levered betas are, so from these beta calculations, just to the left of that, you'll see a WACC analysis. You can see these red numbers here. Yeah, it's interesting. You're even stuck on a different screen than I am. It wouldn't let you see when I recalculate it. But these, you're not even seeing what I'm drawing. It doesn't make any sense because it's not the same spot. Let me do this. Let me stop sharing and then reshare. Let's see if that'll solve it. Here, for this. You're seeing it now. Okay, so I put in GE, which you didn't see, but I put in GE and it came up with this list of competitors, and I'm reluctant to move over there because I don't want to lose what I was going to show you. But over here is the unlevered beta, and then down below they calculated GE's levered beta right over here. And then to the left of that, over here, are just a bunch, it is a calculation for the weighted average cost of capital for GE, but anything in red you need to replace. That's just a placeholder value. And you can pull all that data really easily. Marginal tax rate, you can pull right from the 10K. The market return, they're saying 11.3. I think that's high. So if we're talking about a market premium of 5%, what's your risk-free rate? They're saying 1.76%. So that would put it at about, you could say 6.5 to 7% for a market premium. GE is not a company that would need a size premium because they're so huge. And then their cost of debt, you'd have to pull that from somewhere at cost of preferred if they have any. So you can absolutely use Capital IQ, and it's really quite simple. You just have to substitute in for anything that's in red. Okay, because those are just placeholder values. Does that make sense? If you need to unlever a beta, this is the place to do it. It will do most of the calculations for you. All right, let's get back to the problem now. Move some of this stuff out of the way so I can make it full size. Okay, so for problem 12, come on. The nice thing is they gave you the market values. The only confusing thing here was to remember that notes payable are also debt, and so that we have to include the market value of notes payable too. And the reason we separated out, you could lump them together if they had the same costs, but they don't. The notes payable are at a different rate than long-term debt, so we need to separate them out. So this number was all given in the problem under invested capital in the balance sheet. And this is the same thing that's in the balance sheet. It sums to 2.2 billion. And then the notes payable is 20 million of that 2.2 billion, so it's 0.91%. Long-term debt's 28.32%. And then owner's equity is 71%. Yeah, Ellie?
Sorry, I had to unmute. So for the long-term debt, I actually took the book value, and it was only because earlier in the lecture, I know you were saying we should use book weights for debt. So did I misunderstand that?
You didn't misunderstand me. It's when they give you a market value, you want to use it, but in the real world, you're not usually given market values for debt because they're not frequently traded. So the pricing on debt's typically pretty stale. So we use the book value because it's close enough. But thank you for correcting me. If you're given a market value of debt, use it. You just typically aren't given one. So we use the book value of debt because it's usually close enough.
Gotcha. Thank you so much.
Sure. Sorry for the confusion.
Oh, it's okay. Thanks.
Okay. Everybody good on how we came up with those market values and the weights? Well, once we do that, then we need to apply to come up with our weighted average cost of capital. And the first thing is in the short-term debt, they tell us that the cost is 9% and it's after tax. So the cost of debt for our short-term is 5.85. That was ugly. For our long-term, they tell us that the cost of long-term debt is 8.5%. And so 8.5% on the after-tax basis with a marginal tax rate of 0.35 gives us a long-term debt cost of 5.53%. And the cost of equity, they told us the risk-free rate, they told us the beta, and they told us the market premium of 5% to come up with 11.42%. And then we put all of that data into the weighted average cost of capital. 91% of, or sorry, 0.91% of our funding is coming from short-term debt with a cost of 5.85%. 28% is coming from long-term debt with a cost of 5.53%. And then the rest, 71%, is coming from that cost of equity. So it gives us an overall cost of capital of 9.69%. Any questions on that? Somebody's gearing up for a question. No? Okay. The knowing how to do this is important because some of you are going to need to actually do these calculations. That's why I wanted you to have a variety of types of companies within your team so that you'd see, and some people are just going to be able to pull it right from Bloomberg. Others are going to pull it from Bloomberg, but they're going to have to adjust their market weights because their company has a lot of leases. And others are going to have to use comparables or develop the model a little bit more fully. Okay. Now, finally, the last way to calculate cost of equity is, the book calls it imputed rate of return. It's the Gordon growth model or the dividend discount model. Works great if your company pays dividends and the dividends are growing and they're growing at a constant rate. And that just, it applies to such a small spectrum of companies nowadays that we don't talk about the dividend discount model as much as we did. You may remember when we talked about it previously, we talked about finding the price by looking at the dividend next year times 1 plus, sorry, the dividend today times 1 plus the growth rate, which is the dividend a year from now, divided by the required return minus the growth rate. Well, here we're trying to find your cost of equity. So if we rearrange and solve for your cost of equity, it says your cost of equity is equal to the dividend next year divided by your stock price, and that's the dividend yield, plus the growth rate, how much your dividends are going to be growing. So you can use this if your company pays a dividend. John, you may with BB&T, I can't remember. They do pay dividends. It's possible dividend discount model works for them. Christine, it's possible this works for Allstate too. You may be able to use it. You don't see it used very frequently. You can always use it as a backup just to check your numbers if you come up with a cost of equity using Bloomberg. Those companies are stable, so you should be able to pull a cost of equity from Bloomberg. But if you wanted to check, and they're paying dividends growing at a constant rate, I think those are the only two firms I can think that this might even kind of apply to. So an example of using the dividend discount model, the only thing hard about DDM, and it's not hard, is just to remember that to find the price or the return on equity today, you need the dividend a year from now. So in this case, the company paid a dividend of $3.12 per share. That means they just paid that dividend, and the stock closed at 70.91. The growth rate is 3.92%. And they're saying that they're going to grow at a constant rate, so we can use that formula. If the stock just paid a dividend of $3.12, that's the dividend today. So if that's the dividend today, we have to multiply that times 1 plus the growth rate to get to the dividend a year from now. Dividend a year from now is the current dividend times 1 plus the growth rate. We divide that by the current price. This whole thing is called the dividend yield, and then we're going to add to that the growth rate. When we do that, we come up with a cost of equity of 8.5%. Any questions on how we do a dividend discount model? Those flashbacks are coming on right about now. That chapter 13 just never goes away, does it? Okay, so another issue is which cost of equity model you're going to use. The reason we don't use dividend discount model all the time is because so many companies don't pay dividends, and if they do, they don't pay them growing at a constant rate. The dividend discount model just tends to be a not very good predictive model. It works best for highly regulated firms, regulated utilities, but even their growth isn't terribly stable because the regulators will change the growth rate through time, their allowances. So we put this all together, which we did in the problem we just did a few minutes ago. We need to figure out what the market weights are for our companies, and then we calculate our costs of debt and we calculate our cost of equity. For this particular firm, we calculated it 3 different ways, and then you can take an average of those 3. If you remember from 703, I'm not a huge fan of averages. My preference, because then you're getting volatility in there, my preference is which model is most reflective of the firm. But this book also talks about doing calculation 3 different ways and averaging them together. That's not wrong. But if you believe CAPM is the best estimate, or you want to be more conservative, and so you use the 3-stage DCF model and come up with 8.55%, have a rationale and stick to it. But it's not wrong to take an average. And when they do the averages based on the market weights, they end up coming up with a weighted average cost of capital of 9.23%. I'm not going to go through this problem. It's the one that's in your book. But I do want you to do one more problem. I want you to do number 14. So I'll pop you back in your rooms to take a quick look at number 14, and that'll be the last problem we do for tonight. And then we'll just finish up the chapter, and I'll give you a little bit of time for your projects. Rooms should be opened. Lizzie, did you guys have time to finish?
I think we just did part 1.
Okay.
Or yeah, part A.
Okay, I think everybody's back. All right, for this one, the information they give us is the risk-free rate is 3%, the market premium, the beta for Southern Bell is 0.62, and the beta for Verizon is 0.79. So using CAPM first, we have the 3% risk-free rate plus our beta times the market premium to come up with a 6.1% cost of equity for SBC and 6.95% for Verizon. Anybody have any questions on that part? The only thing tricky about CAPM is to remember whether they're giving you the return on the market or the market premium. The market premium is the return on the market minus the risk-free rate, and that's what they gave us was the premium. So we don't need to subtract out the risk-free. It's already been done. Everybody okay on that one?
Yes.
Good.
Wait, why did you use 0.79 as the beta for SBC?
I used 0.79. Oh, did I switch them? Let's see.
They're the same for both. I think it's just a typo.
Oh, thanks. Sorry, SBC, it should be 0.62, and that gives me the 6.1. Thanks. That is a typo. Good catch, Bennett. So this number here should be 0.62, but that number is correct. Good catch. I'll fix that before I post the slides tonight. Great. Put the formula last. Oh, so in the formula, this is the only thing to remember. Are they telling you the return on the market or the market premium? And in this case, they told us the market premium. So risk-free has already been subtracted out. Okay, so now to do the FAMA French model, the only thing to remember with FAMA French is, okay, so this version of the formula has risk-free on this side. So it's the risk-free rate plus the B factor, the risk-free plus the B factor times the first risk premium, that's the essentially the CAPM premium, plus the S factor times the small minus big factor, and then the H factor times the high minus low, that's the value factor. And when we substitute those in, we have the 3% risk-free. They gave us the S and H factors, the coefficients, and they also gave us what the calculations would be. The only thing with this problem to note is this negative sign for both firms on the coefficients of S. And the reason those are negative, anybody have any ideas why we have a negative sign there?
Because they're large firms.
They're large firms, so actually their size reduces their risk. So they're getting a break in essence because their size is so large that it's causing their risk exposure to decline a little bit. So when you do that calculation, SBC has a cost of equity of 8% and Verizon has an 8.16%, and that compares to what we calculated here of 6.1 and 6.95. The book would tell you to average those together. Before I averaged, I want to look at the R-squareds, and if my R-squared for Fama French was something higher than 50%, I would use just Fama French. If it's not higher than 50%, if it's somewhere in the 30% range, you could average, or if you want to be conservative, use the higher cost of equity. If you want to be a little bit aggressive, use the CAPM in this case. CAPM is the lower rate, so that's why it's a little bit more aggressive. Any problems or any questions on that problem?
Can you repeat that? You said if the R-square was above 50%?
Yeah. So the CAPM R-square is typically around 30%. And so if you're getting more explanatory power with Fama French, and by more, you want it to be substantially more, at least 50%. With Fama French, pre the recession, we used to see R-squareds above 60 routinely, and you've seen them as high as 80, probably even higher than that, but you've seen some pretty high R-squareds. So that's why the model was just so revolutionary. It was explaining so much of the variation in returns, but it just didn't hold up after the recession. But if you get an R-squared that's significantly above the CAPM R-square, you can use Fama French. You're just not seeing it as frequently as you used to, and you'll get questioned about it. But in this case, particularly because it's conservative, your estimates are more conservative, and most people that do valuation tend to be a little bit aggressive. Okay, big things to remember with coming up with your weighted average cost of capital. First, it's in Bloomberg. So if you have the ability to have a pretty straightforward company, you can pull it right from Bloomberg. And Bloomberg doesn't tell you all of their assumptions, so you're not going to be able to back out to come up with their weights or their rate. But a lot of companies just use Bloomberg data. You want to make sure you're using market value weights if they're available. Typically not available for debt, and so we use book value. But if market values are available, use them. If your company's capital structure is changing, consider adjusting your weighted average cost of capital through time. So you might use one rate that's higher for the first 3 years, and then a different rate for years 4 through 6. And then by 7 through 10, you've sort of hit your target capital structure. Your rate will adjust as your target weights adjust. So that's, remember what we said early on, making your models more complex doesn't necessarily make them better, because the more complexity you add, the more assumptions you're putting in there. So if you can look at comparable firms and see where their unlevered beta is and lever it back up, that might be better than trying to predict your target weights, but it's yours to do. It's a little bit more work to come up with target weights, and there's a lot of assumptions that go in there. Better to use comparable firms, but it is possible to do it with target weights. Your yields on your bonds, if your bonds are publicly traded and you can find them, great. If not, you can do a build-up method by looking at the riskiness of your portfolio and what rate are bonds of similar risk earning right now. There's lots of different ways to do cost of equity. This book suggests you use multiple ways of doing it. I almost never see dividend discount model used. Fama French is being used less and less. So to me, using CAPM or CAPM with a size premium is probably the most that I would do. And I don't tend to average them together. I pick a method, and it's a whole lot easier to me to support one method and why I did it than it is to talk about an average. I don't tend to do a whole lot of averaging. Let's see. Oh, and you are forward looking. So if you're expecting changes in your company going forward, it's perfectly okay to make adjustments based on your changing expectations as time goes on. Let's see. That's everything we just said. One of the things we're going to look at in the next chapter is not using a cost of capital for the entire firm, but instead using project-specific or divisional cost of capitals, and we'll get into that in chapter 5. For the purposes of our project, that's not an issue because we're going to use overall firm-wide cost of capital. We're valuing the whole firm. But if you're trying to get a project approved, you may need to come up with a weighted average cost of capital for your division. And then a lot of these methods come into play because your division often will not have the same risk profile as your company overall. So you'll look for, I'm getting into chapter 5 now, you look for pure plays in your industry and what does their capital structure look like, and the unlevered betas become even more important when we're looking at project-specific weighted average cost of capital. But for the purposes of our project, we're just going to need an overall firm-wide cost of capital. I think that's it. Okay, yep, that's it. Okay, what questions do you have on weighted average cost of capital? And the room goes silent. Y'all are just dying to go watch those debates or see if the Yankees won, aren't you? All right, I'm going to open the rooms in case you want to spend a little bit of time with your group. It's already getting a bit late, so if you're welcome to go in and say, hi, everybody, I'm done for the night. I think we're in good shape, but you're also welcome to go in there and work. Next week, right at the beginning, Linda's going to be here to talk about IPO process and valuation, and she'll be available for any questions. Keep in mind, Rosetta's coming, and so we'll talk about that after she leaves next week. So if you want to think a little bit about privately held firms, you can do that as well and ask her questions there too. And turn in your projects by whatever time it says on the syllabus. It's either 9 or noon next Tuesday, so I have a chance to look at them before class. And we'll do chapter 5 next time after Linda leaves. Okay. You guys have a good evening, and I'll see you in person in Timonium next week. Bye, guys.